welcome. People will be filtering in over the next few minutes. So if you want to go ahead and write in the chat who you are, where you're from, where you're joining from, and maybe something that you're interested in getting out of this webinar. And just make sure that you when you're writing in the chat, make sure to click on the drop-down menu to panelists and attendees, and then the other attendees can see your answer as well. So just so you know, my name is Erin. I'm joining from Zurich. Where are you guys joining from?
Are you talking to us or the?
Yeah, you guys, the guys you can see on the camera.
Perfect. Yeah, hi there. I'm Peter Wüthrich. I'm based in Zurich. I'm part of the multifamily office VALUEworks, where I look after the investment consulting part, and we are mainly driven by sustainable impact investors who we help to align their capital to their values.
Thanks. And what about you, Olivier? Where are you?
So I'm Olivier. I'm born in Geneva, but I grew up abroad and then later in Basel, and now I live in Zurich since 20 years. I work at ECOFACT, which I had the honor to co-found and run now. So Gabriel is also with me at ECOFACT. He can tell you a bit more about the company, but that's where I'm from.
Good morning, everybody. So my name is Gabriel. I'm also joining from Zurich, although I come from Brazil. And my background, I have a legal background, study law, international and EU law as well. And I work at ECOFACT together with Olivier. And at ECOFACT, we help companies, majorly financial institutions, to tackle and comply with sustainable finance and corporate responsibility regulations, as well as other things.
Thanks. And just so you know, there's also Michelle hanging out. She has her video off, but she is doing tech. So if you have any issues or any questions related to tech, you can write to her directly and she can help you out. So we're going to still let people filter in, but I'll go ahead and start doing some more of the administrative stuff. Yeah, welcome to this webinar. It's titled Relevance of the EU Sustainable Finance Regulation to Small Asset Managers and Wealth Owners. This is one of our webinars, actually the 9th webinar in our Think Big, Think Impact webinar series, which is part of a project that's sponsored by EIT Climate Kick and Financial Centers for Sustainability. So if you don't know me, my name is Erin Duddy. I'm the online and next gen program lead at the Center for Sustainable Finance and Private Wealth. It's great to have you joining us today, and I'll be your moderator. And before we kick off the webinar, I'd like to highlight a few features of this platform. So we're going to be doing more of a panel discussion, starting with kind of a presentation, and we'll have time for Q&A throughout the session. So if you have any burning questions to write in, or anything that comes up throughout the webinar, you can use the Q&A function, which is at the bottom of your screen. You'll see a little toolbar. Actually, do I see the Q&A function? Okay, you won't see the Q&A function, but please, please submit your questions in the chat, and we'll be collecting them, and then we'll answer them that way. Okay, so in that case, again, I mentioned before, if you look at the chat box, the standard setting has the messages only sent to the panelists, so us, everyone you see on the screen. And we suggest that you switch your setting to send a message to all panelists and participants or attendees, so that other participants can also read your messages and questions. So now that the technical bit is behind us, we have an exciting program for you today. First, we'll start a bit with a short introduction of the topic with Gabriel, and then we'll dive into the panel discussion with room for audience questions throughout. We'll end with a few minutes for key takeaways from our speakers. And our speakers already introduced themselves a little bit. I'll give you a bit more of a background so you know that where they're coming from, where their knowledge and experience is, and how it's related to the topic. So first, I'd like to introduce Olivier Jaeggi. He's the managing director at ECOFACT. Prior to founding ECOFACT in 1998, Olivier worked in credit risk control at UBS, where he was in charge of managing environmental risks. He's a member of the Sustainable Finance Working Group of Institute of International Finance and of the Professional Risk Managers International Association's Subject Matter Expert Advisory Group on Reputational Risk. Olivier regularly writes for the MIT Sloan Management Review's sustainability blog, and he's a guest lecturer at the University of Zurich and has also lectured at ETH Zurich, as well as other universities. Next, we have Dr. Gabriel Webber Ziero, LL.M, and he's the senior consultant and head of policy outlook at ECOFACT. Gabriel is a lawyer specialized in strategic regulatory compliance in the areas of corporate responsibility and sustainable finance. In this context, Gabriel supports financial institutions in understanding and acting upon regulatory requirements, as well as contributes to the organizations like the OECD, Swiss Bankers Association, and Swiss Sustainable Finance. Gabriel is licensed to practice as an attorney at law in Brazil and holds a doctorate in international and European law from Roma Tre University in Italy, as well as an LL.M from Leiden University in the Netherlands. He's a lecturer at the Certificate of Advanced Studies in the Sustainable Finance program of the University of Zurich. And lastly, we have Peter Wüthrich. He's the head of investment consulting at VALUEworks, and his professional joy stems from empowering investors to solve their investment and wealth structuring issues, often driven by unique family dynamics. He does this as the head of VALUEworks investment consulting practice, where he advises asset owners on all aspects of their long-term investment strategies. Before founding his own research and investment consulting firm, Peter served on the Rothschild Bank Zurich's executive board and was the bank's chief investment officer and global head of research. Peter invented the CanTrade Fund Radar, the first fund analysis tool, using visual means to illustrate complex evaluations of asset managers. His first experience in the finance sector reaches back to 1987, when he joined Barclays Bank in New York as a financial analyst. Peter graduated with a master's degree in banking and finance from the University of St. Gallen in Switzerland, and he subsequently became a CFA and FRM charter holder. And so now that I've introduced our speakers, I'm going to hand it over to Gabriel to lead us through a short introduction and overview of the topic. So over to you, Gabriel.
Thank you so much, Erin. Good morning again, everybody. So for me, it's a big pleasure to be here with you all today to talk a little bit about what the EU is planning to do in the area of sustainable finance regulation, and try to make it as clear as possible, the more practical as possible, and output-oriented as possible. This overview and this kickoff presentation to the panel discussion that will follow. Our focus today will be on small asset managers and wealth owners. So to start, I think I always like to use this visualization slide to talk about from where we come from and to where we are going when it comes to the EU sustainable finance regulations, landscape, action plans. So all dates back to, we could put it like that, to 2016, when the European Union issued the Capital Markets Union Action Plan then. And one of its action points at that moment was to engage with a group formed by different stakeholders to think about sustainable investments. This action point led to the formation of what became the high-level expert group on sustainable finance, which worked throughout 2017 and issued in the beginning of 2018 its report with recommendations to what the European Union could do in this area to first help asset owners that want to transition, to move towards a more green, sustainable investment options by addressing the practices of financial market participants and financial advisors in order to make their practices in this area more transparent. Simply putting, also, this could be summarized into combating greenwashing. Then in March 2018, the EU Commission launched what is now the famous EU Action Plan on Sustainable Finance, which, by the way, now will be revised, and then revised EU Sustainable Finance Action Plan or strategy will be issued in the coming months. But then in March 2018, the EU issued this ambitious action plan with 10 actions covering the most varied aspects. So the European supervisory authorities were asked to provide their comments and inputs on how the European regulatory framework could be used to combat short-termism when it comes to investment or the management of financial institutions. The European Union also started to discuss 3 main regulations, which all today are published in the European Official Journal of the European Union and in force, meaning that these regulations are already a done deal. What we are now waiting is to these regulations start to be applicable. So what are these 3 key regulations? The first one is the regulation on climate transition and Paris-aligned benchmarks. So the European Union here created 2 sets of benchmarks to help investors to know on what they are investing in this when seeking to contribute to a climate transition, or that having their investments aligned to a Paris-aligned scenario, meaning 1.5 degrees. Then the European Union also issued what, in my opinion, is the most relevant regulatory piece, take into account its effects and the impacts on the actual processes and activities of financial institutions, which is the Sustainable Finance Disclosure Regulation. And last but not least, in July this year, we have the adoption of the famous or the long-awaited regulation on the EU Sustainability Taxonomy. This regulation defines the objectives, what objectives economic activities can pursue in the area of environment. They are 6: climate adaptation, climate mitigation, water and marine resources, circular economy, combating pollution, and biodiversity. And now where we are today, we are waiting the European Commission to issue what it's called in the jargon level 2. So what is level 2? Regulations that provide further information and details on how things can be done from an implementation point of view that complement level 1. There we are waiting the European Commission, the European supervisory authorities to conclude this process. At the same time, we are waiting now in November, the decision from the EU Commission on the path to go for the EU Green Bond Standard, as well as for the potential EU Eco Label for financial products. So we are at a moment where we are at the same time at the end of a certain journey that started in March 2018, with the adoption of the EU Action Plan. We have already the regulations in place. First implementation actions are expected by March next year, but we are also at this moment of transition, new beginnings. We have the new beginning for the EU Green Bond, but also the revised EU Sustainable Finance Strategy that will be issued this year. But I think that's okay. Okay, Gabriel, that's a nice introduction, but what does this mean for financial advisors? So when looking to this regulatory landscape, and in particular to Sustainable Finance Disclosures Regulation, financial advisors are impacted in 4 different ways, or they are required to do 4 different things. The first one, financial advisors are required by the regulation to inform in their websites how their investment advice process integrate sustainability risk considerations. These, of course, can do in a variety of ways. There is practice on the issue, but what is now expected is that you clearly communicate what do you do and how do you do. The second, which is in this point the novelty, is also that financial advisors will be expected to disclose how they consider principal adverse impacts on sustainability factors in their investment advice process. What does this mean? While sustainability risks mean the material impacts caused on the value of an investment caused by sustainability factors. Principal adverse impacts mean the impacts, the adverse impacts caused by an investment on sustainability factors. So we have a shift in direction if you would be drawing with arrows and etc. So here we have a novelty from a regulatory point of view, because some could argue that, well, as financial advisors are already expected to disclose all the risks, how they integrate all the current and future risks in their investment advice process, sustainability risks would already be integrated. What we have now here is this 100% clear. Sustainability risks are a risk and you should consider them and not let them aside. The third action that financial advisors will be asked to do is to include in their remuneration policies how these remuneration policies are consistent with the integration of sustainability risks into their investment advice processes. So how take into account sustainability issues in the firm as a whole, meaning strategy, but also at the level of investment advice, can impact remuneration policies, more specifically, not the baseline salary, but the variable contribution section, so the bonus, and et cetera, et cetera. Last but not least, financial advisors will need to include in their pre-contractual material. So meaning the documents they need, they are required, for example, under MiFID to present to clients before entering in a relationship of financial advice. They will be requiring these documents to integrate the manner, so to disclose also the manner in which sustainability risks are integrated in their advice, being this in the area of investment or insurance. So it's a kind of a copy and paste from the first action. And the second one is to include in these pre-contractual materials the results. Okay, we assessed principal adverse impacts. What are the results we found when looking to the likely impacts of sustainability risks on the returns of the financial product they are advising? So closing this circle. Going forward, and having an eye on the time, how can financial advisors do that when integrating ESG, sustainable finance issues into for example, the MiFID value chain? So here we need to think at the different segments of already existing process you have in place. So you don't need to create something from scratch. It's just to insert small pieces in what you are already doing. So when doing client classification, you need also to identify, okay, potential conflicts of interests that may damage the client's interest by including sustainability preferences. And here it's important to really, what do we mean by sustainability preferences? We need really to be narrow. Target market, so ensuring that the products and services that you may be offering are compatible with the sustainability preferences. That when doing the suitability and appropriateness assessments, that you will obtain from the client the right information that you need and ask clearly about it, not in a subterfugeous way, and also provide the client with all the information the client may need and how the recommendations that you are providing meet the client's sustainability preferences. And information duties always provide the client the description of the factors that are influencing your recommendation, the financial instrument you are recommending from the angle of sustainability factors. So you need also to think about it. As a concrete example, or not as a concrete example, but jump into some key considerations to kick off our discussion. So what is clear, and looking back to what the European Union started doing in 2016 to today. So we have a clear shift on the integration, on the consideration of ESG, sustainable finance issues into financial advisors' fiduciary duties. This is not more up for discussion. before 2016, we had several discussions. The PRI, for example, was very vocal. This is a part of fiduciary duty. Others were, no, that's against. No, now today in the European Union, that's clear. We need, always when having these inter or transgenerational lenses in mind, think about the changing perceptions of what adequate or suitable ways of investment are. So for example, my father or my grandfather could think that investing in utilities company, for example, in an oil company, it's a good investment because everybody needs oil, it's fantastic. It's where economies are built. However, my generation, myself, we may well, utilities companies are not the most sustainable players in the that there are. And we know already today that they are heavily involved with CO2 emissions. We need to curb. We have the Paris Agreement. We have countries all around the globe setting 2050 as the deadline or the moment to achieve carbon neutrality. So this may not be an interesting sustainable investment in the long term. And also how these different generations see these different issues. And why it is important to take this into account. Because potential liability risks may emerge from these breaches of fiduciary duties, in case we are not fine-tuned with our clients on what they want, what they expect, and how can we then deliver to them the best and most appropriate advice. So I will stop here so we can have more questions, more time for questions and Q&A. So back to you, Erin.
Thanks so much for doing that, Gabriel. I know this is kind of it's very complex to go through as just a non-legal person. So it's good to have it like in a very clear format. So for the audience, in case you want to continue to submit questions, you can either put it through the chat or through the Q&A function. But one point we wanted to start with was this point on sustainability preferences. And sustainability preferences, they guide asset managers in identifying suitable products for their clients. And with the new regulation, this is changing the game in how asset owners can voice and implement their preferences, and how asset managers are required to consider those preferences in decision-making processes, as well as how fiduciary duty is interpreted and implemented, as you pointed out, Gabriel. So one of the first questions that we have here is for Peter. And so how do these preferences that we're referring to of asset owners play into the due diligence process of looking for an asset manager or in developing a set of products?
Yeah, thank you. It is interesting that it took so long that these considerations now kick in the reality, because, for instance, when we started with our company about 16 years ago, and our clients asked us to look for sustainable investment offerings, there were very little, and banks and asset managers really rolled their eyes when we asked for integrating climate risk into their investment decisions, or as Gabriel said, probably avoiding some of the fossil fuel producers because there might be some issues with CO2. And still, some roll their eyes when we come with these questions. So pretty obviously, we don't choose them as asset managers for our clients. So it is actually detrimental or the key decision factor for our clients to do business with an asset manager, whether that company is actually doing basically what the action plan proposes to do: integrate ESG, thinking long term, asking the client what she wants, as in her preferences, including sustainability preferences. So yeah, we think it's there's no choice that asset managers who want to do business going forward need to comply to these rules. If they haven't done so, and those who haven't done actually out of scope for at least our clients.
Yeah, got it. And I mean, you kind of touched on it a little bit, Gabriel, about sustainability preferences, but could you go a little bit more into detail about how the new regulation addresses these and then how they will actually have to be implemented functionally?
Yes, so that's a very good point, because what we have so far are the draft draft implementing acts, complementary acts under MiFID, UCITS, IMFID. All these regulations are being changed. But what, from the perspective of the European Union, what you need to do are two basically three things. So first one is to do not avoid to ask these questions. So you need to ask these questions. In which way? In a consistent way, as you do with other key issues, that when asking about the client's preferences. So you cannot set here a different bar for sustainability risk, either lower or small, or higher or lower, because it is a sustainability issue. So you need to make it consistent, and you need to integrate this on your on the process you already have in place. So what the European Union doesn't want is that you create a separate workflow to a separate questionnaire, a separate stream for sustainability considerations. And also you need to ask this across the board. You cannot just segment also this, oh, I only do this for a particular type of products because this person already showed a certain type of interest. No, you need to do this across the board.
So I have two questions and following that up. First of all, like how much room does the regulation actually give then the asset managers themselves to produce these questions or identify like what is a sustainability preference? And how much is it already written into the regulation? So
the regulation keeps a very broad, the regulation, as often is the approach of the European Union. You first tell you tell your audience what you expect from them, but you don't tell exactly how they do it, because the European Union also aims to foster different market-based solutions or approaches, which then leaves a kind of a window of opportunity for collective action among different financial players on ways of doing it. And then in a second step, the European Union may come and say, no, this is the way of doing it. So at the moment, as we are still at the level of draft delegated acts, we are still at a very, from a regulatory point of view, we don't have much nitty-gritty details on you need to ask this question, that question, and this should be a yes or no or a maybe. So we are still at a more principle-based approach from the regulatory point of view.
Okay. And so the second question I had was, you were talking about that these questions need to be asked in proportion to other risk questions. Is this kind of like if you have like 5 questions on financial risk, then you also have to have 5 questions on sustainability risk, or how is this kind of like assessed?
Could you just repeat, because I had just a cut, the first type of risk you mentioned? 5.
So the like a financial risk,
yes.
So would it have to be like the exact same amount of questions, or what do you mean by that? Like, how do these have to be equal?
So we need to compare. So that's a very good point, which also relates, for example, to how integrate sustainability risks into investment policies or into remuneration policies. Is the same approach. What is expected is that you do this in a consistent way with comparable elements. What does it mean? So first, in case the strategy of your institution has a very clear tie with sustainability issue, or your offer, your business model has a very tight alignment with sustainability issues, you need to give more emphasis to that, of course, than if you just have no particular business strategy in relation to that. And then when it comes, we need always, the regulations always do a distinction between two different types of issues. The first one are the financial questions. So financial risk, credit, all these financial hard risks. and those that they call more qualitative or non-financial issues. And there is where you need to look among these equals, how do you take them into account? So, for example, how do you ask about other topics that already now are related to sustainability? So, for example, anti-corruption and bribery, you need to make a same level. So you cannot have 10 questions about sustainability, 4 about financial elements, and 1 about legal compliance. You know, you need to find a fine-tuned and balanced approach.
Yeah. Okay. Got it. So I have a question about fiduciary duty, which we also touched on a little bit for Olivier. So how is fiduciary duty changing with the regulation on sustainability preferences? And are there different risks for small asset managers than for larger institutions?
Yes, these are 2 very complex questions. Apologies, by the way, for walking away, but we have a construction site in the building and they started competing with your event. So I had to close the door. Well, fiduciary duty, it's a long topic. I mean, it's been discussed since many years. I mean, it's always been clear that asset managers have a responsibility to basically protect their clients from financial harm or from financial damages. And there's been a very long debate over the last almost probably 10, 15, 20 years, whether actually considering ESG risks would violate the fiduciary duty because you're moving away from the real relevant financial aspects. And I think it's quite clear since 5-10 years, the PRI has worked a lot on that, and the UNEP-FI, that now actually if climate risks is really a financially material issue, then you need to consider it. So this has kind of like almost turned around. And it's also interesting to see how, for example, regulators in Switzerland, FINMA, they long said they didn't have a mandate to address climate risks, but now they suddenly say, well, actually, we don't even need a legal change. If financial risk is material, then we can just consider it. So it's kind of like, it's kind of clear that the expectation is now in the room that climate change is not something you can ignore. You need to consider it, and therefore it's part of your fiduciary duty. I almost tend to give the second question to Gabriel, but my short answer would be like, I don't think it matters how big your institution is. I don't think a small asset manager can just disregard climate risks. I mean, we had the situation in Switzerland, for example, with the pension funds, that they would say, well, it's not really a topic which is relevant for us. We just follow the market. And if the market moves, we'll follow the market and we'll automatically be out of all these fossil fuel things. But I think that's a very far too reactive reaction, which would not properly take into account the fiduciary duty aspect. I think what's not possible today anymore is that you just say, it's not a topic which is relevant for us. You can have an opinion, you can say stranded assets, I don't believe in this crap. I think fossil fuel industry is a great industry. There's a lot of profits to make there. We're responsible to stay in it, but you need to have that opinion documented. You can't just have this gut feeling of it's not relevant anymore.
Yeah. Gabriel, did you want to say something else on the
No,
the size
I completely subscribe to what Olivier has just said, and just to make it clear, now we passed the moment where the integration of these issues is a matter of personal beliefs, either from the client or the advisor, the manager. Now it's a matter of legal compliance, liking it or not. We need to do. You will need to do it. You will need to integrate it, and you'll be exposed to the same levels of risk and liability risk, compliance risk that you are exposed to other types of legal and compliance issues. For example, anti-corruption and money laundering situations. So now we are at the same level, and yeah, we need to start taking these issues into consideration seriously in order to mitigate these risks.
Mm-hmm.
And maybe one brief comment on that. I think that the thing is that Switzerland is lagging behind here. We always have the feeling we're such an amazing pioneer when it comes to sustainable finance. And I think great things have happened in this country, but we kind of got stuck somewhere in a specific situation. And other jurisdictions are moving much, much quicker. So I think in Switzerland, the situation legally is not that clear, but in the European Union, absolutely, it's something you now have to do. Yeah, it's also something we can talk about a bit later. Is why is the EU actually doing that, and what are their ambitions, etc. So it's really interesting to observe that.
Okay. I have one question for Peter then. So we've been talking about integrating sustainability preferences in the suitability assessment. And I find this interesting because maybe not all clients understand fully or what these sustainability concepts are, or how they feel about their preferences. Maybe this isn't necessarily the case with your clients, but I was wondering if there's any sort of like education piece that you need to go through with your clients to fill this sort of gap in general.
What we noted, especially with, let's say, the older generation clients, is that these buzzwords, sustainability, impact, ESG, SRI, causes some headaches and some pushback, and they say, why can't it be that simple how it was before, and I don't like this. And as soon as we change the narrative and, for instance, talk about future fitness or future fit investment, we wouldn't call it future proof because this is a claim which no one can really deliver on. But if we simply change the narrative, a little bit like what we just heard, it's not just ESG, it's not just compliance risk, it's long-term investing, and this is what, for instance, the old generation immediately understands, is simply factoring in all sorts of huge risks out there, but also sees opportunities which are out there. And if you discuss with older investors, they say, yeah, that's normal investing. Anything else is speculation. And I don't want to be engaged in speculation. I want you to invest in the long run. So my recommendation is just approach the clients with the right framing. As in, for instance, you know, the next gen, the Gabriels of this world, they understand divest fossil fuel stranded assets. His grandfather probably doesn't, and gets confused and then pushes back, even though he probably thinks alike, that investments shouldn't destroy our earth and our societies in order to make money. So yeah, we need to be creative in tackling that, but it's easily possible, because when you describe these topics correctly and in a language the client understands, no one is really pushing back. They say, yeah, but you're stating the obvious. Do no harm. I mean, why should I want to hurt the earth or some social you know, systems with my money? No, I don't want that.
Yeah, it's a really great point. I think a lot of us can connect on these sort of core values. And when we meet people where they're at, then that's a real power in that. The next topic we wanted to talk about was disclosure. So disclosure of sustainability risks and adverse sustainability impacts is a prominent part of the regulation and starting to come into effect already in 2021, which is only a few months away. And in many cases, this does not apply yet to small asset managers. So either Gabriel or Olivier, from a risk perspective, what should small asset managers be disclosing and along what timeline?
I would let Gabriel go ahead on this one because I think it's a legal question, and then add some big picture thoughts on it.
Yes, so I think it's important to take into account who you are in this complex world of financial institutions. What is your role? Are you the institution? Are you the entity providing the financial advice, or are you actually the one manufacturing the product? And here is the first distinction, because most of the disclosure, the heavy lifting, will be needed to be done by those manufacturing the product. as the regulation frames, and the advisor needs to pass on this information. And when passing on this information, the advisor also is expected or is encouraged to use its leverage with the institutions he's advising on products, that these disclosures are done in an understandable way, because as Peter was mentioning, we cannot go to clients and perform disclosures which are written in a cryptic language that you need to have 5 dictionaries plus a magnifying glass because the letters are so small. No, needs to be reader friendly, all this information that you are disclosing. So the first, what to expect. So by March next year, if you guys remember the slide I was showing before, so we will need to have in place how sustainability risks are integrated between the investment advice process, how remuneration policies integrate these issues, the integration of sustainability risk into the advice process. We will need then to adapt our pre-contractual informations by already March next year, how they take these issues, these risks into account, and then be ready to when the financial market participants, so that the manufacturers, start to disclose, to inform on principal adverse sustainability impacts, to pass on also this information as according to the regulation. So the expectations, if you would need to say who needs to do the heavy lifting, is those manufacturing the products, less so for those advising on investment and insurance products. And then the important thing is to keep clear, as Peter was mentioning, and sorry, Peter, for always quoting you, clear communication, clear documents, and also using templates that facilitate the understanding of this information, and having this not only in printing, but also in your website. Also in your website. I think that's in a nutshell where we should start.
Did you want to add any big picture comments, Olivier?
No, I think that was quite a comprehensive answer. I think the challenge just that asset managers, of course, will face, or investment advisors will face, is that they will receive very, very different approaches from different asset managers. So basically, everyone will be doing it a bit differently. There will be some alignment, I think, with the technical standards that are expected, but there will be very diverse levels of quality and approaches. So it's going to be challenging, I think, to understand those and then to translate them in a way that the client understands. I would be a bit nervous about that. I don't know, Peter, what your view is on that?
Well, we favor diversity, so we are, we like that. We would like to see that each and every stakeholder in this comes up with her really own ideas how to best implement these rules. And there is probably no right and wrong here. Well, there probably is, but let's say in the right spectrum, this is rather wide. And it is actually what also our clients like, this diversity. And when we look at 3 proposals of asset managers, and we see exactly the same thing. They're all using MSCI ESG data. They're all using best in class. They select funds with a rating of larger than 50. Things get a bit boring, to be honest. But if we have one saying we don't buy any of this data, and I think in the Q&A there was a question regarding the data which one can use and the commoditization of ESG data. I can understand that certain large institutions like to have, proven data and rely on them, but it also creates some sort of complacency, because if you have an investment strategy which only chooses the highest scoring ESG funds, this is not what we would really describe as fully integrating ESG. It's just an add-on to the mainstream investment process. So coming back to Olivier's remark, I think it wouldn't worry me if asset managers would approach it differently, as long as they do it credibly. And there will be probably some transition phase where probably after 5-10 years, it will be commoditized, as in there will be certain standards which then everyone applies to. But yeah, and just a word of a notion on these disclosure things. When one does product analysis, you know, that issue of greenwashing is always present, meaning that you sell products which are actually not really green when it comes to the E of ESG. And I'm more worried that this whole disclosure thing will be also greenwashing, because disclosure is one thing, but actually doing it internally, the right policies internally and the right processes and outcome is another thing. This is what we focus on when we do due diligence. And we encountered it during the PRI phase, where everyone and their dogs claim to be PRI signatories, having it in bold on their websites. And when we then dig deeper, basically lifted the rocks and looked under it, there was practically nothing. And some players even said, we don't sign it because we don't want to be put into this greenwashing pool. We actually demonstrate without PRI that we do a good job. So yeah, a bit of a long-winded answer, but we like diversity, but this disclosure doesn't prevent you from doing some homework in looking really under the hood, what the asset manager is actually doing. And then actually for us, it doesn't matter whether someone discloses it properly or not. If she does it properly in her day-to-day work, we prefer it to someone disclosing things and not pulling through operationally.
So I have then a question about internal processes. I mean, is there, under the regulation, Gabriel, is there anything that needs to actually change in terms of internal processes? Maybe we can start with you, and then I'll go back to Peter and get his input on what should be changing.
The answer for that is very short. So I will use this also time to answer the questions that came from the Q&A. Mm-hmm. So the first question is, the regulations that we have nowadays from the European Union are very much output oriented. It's like if the regulator tells you, you need to arrive at the University of Zurich. It doesn't matter if you come on foot, by tram, or by car, or on bike. You need to arrive there. We are at this stage because what the regulator is expecting is to see how people will arrive there. Or if, are they arriving? Are they arriving completely sweat, completely out of breath, still in shape? So this is what, at this moment, the regulation doesn't go to these extremely prescriptive ways in which you should do things. And then quickly answering the questions from the Q&A. So yes, the new Capital Markets Union Action Plan issued last month is envisaging the creation of an EU-wide repository of sustainability-related information. The idea, because the question is whether ESG data needed for compliance will become commodity or free to access. So we are seeing the European Union to move towards the establishment of a sort of general EU-wide repository of information about ESG data. And it's very likely that in the revision that is also already announced of the non-financial disclosure directive, or non-financial reporting directive as other calls, that institutions may be asked, as already in certain countries, to also upload their disclosures in the central repository of data. So there is already movement towards that. And also take into account the whole difficulties arising from an industry perspective on the regulatory technical standards. So the European Union will try to close this gap on the data. And then the other question was about, okay, what about if an institution doesn't want to have products promoting an environmental or social characteristic or as a sustainable investment, so the articles 8 and 9 of the regulation. this doesn't change much, because we have the expectations set at entity level are applicable to all the entities, regardless they offer or not ESG products, Article 8 or 9. And also we will have mandatory disclosures at the level of normal or non-ESG products on how they take sustainability risks into account. So what is the issues related to products promoting an environmental social characteristic or a sustainable investment are further disclosures, further obligations than the expected baseline for even non-sustainable products. So in a nutshell, that is the answer to the questions.
Thanks for answering that. And I'll go back to Peter really quick. There, as Gabriel just said, we don't need to, under the regulation, change any specific internal processes. However, I know based on some conversations that we've had, this is actually really important. So which processes would you highlight would be really important to actually make this aligned throughout the company?
What we see quite often in the current situation is that this integrating of ESG into the overall investment process is not really an integration. It is an addition of one small, let's say, ESG step in the mainstream investment process. And investment process, we really mean client profiling, macroeconomic views, asset allocation, portfolio construction, the instrument research, and that's why it's mostly happening right now. So selecting the right equities, bonds, funds, then portfolio construction, then reporting and monitoring. When you think about these 10 or what steps, you quite often just see ESG happening in the instrument selection. So it's like 1 out of 10. And this, I think, if one interprets the action plan with its 10 action points, strictly will disappear over time, because there is a clear mandate to integrate it in research in general, not just instrument research, stock selection, or bond research, but across everything. And as Olivier mentioned, this climate change notion, which was like something for some eco nutheads 20 years ago, and actually a violation of fiduciary duty, now becomes a fiduciary duty to include. We think it will be a natural development that this gets integrated. So to your question, in the integration of ESG really needs to happen across all aspects of the investment process, not just the client profiling, which is also in the action plan, not just in the credit rating. I think the action plan talks more about credit risk and credit rating, but hey, I mean, climate risk also matters in equity valuation, in currency and interest rate forecasting, in macroeconomics that drives asset allocation. So everywhere. The other thing is, yeah, it should also go beyond ESG. Now everyone is on the E of ESG, meaning climate risk, but Gabriel also mentioned, corruption, money laundering, what have you, which is more in the G. There's inequality as in the S, and yes, there are certain NGOs blaming labor law violations, but as I'm a trained economist, and when I think about a fiduciary duty as advising clients, we think we should focus on all risks and all opportunities, and not just now run into the ESG thing, which again, the old generation anyway thinks it's something of, the youngsters after a few glasses of wine try to save the world thing, and then basically dismiss it as some fad or some fashion which goes away. No, I think asset managers should revisit back their fiduciary duty also in the research and analysis part as having a broad perspective across all risks. And a good starting point is, for instance, the risk map of the WEF. The WEF each year provides a risk map. You can download it from the WEF's website. And there are a lot of risks. Okay, now 2/3 are environmental, and especially those with the highest probability and the highest damage potential are environmental risks, but there are also other risks. And when someone wants to start with a broad risk perspective, this would be a good thing just to start. And what we encounter is when we bring this up, so we view this regulation as a good engagement with asset managers, but also our clients. And we go to asset managers and say, look, why don't you develop in this field? Because it is an area where you can grow, where you can capture market potential, where you can make money. It's the language they normally understand and they listen. It is by simply, capturing all the risk, and the analysts then say, hey, that's actually a cool thing. I learned something new. It's not just boring dividend discount models with estimating discount factors, but it's adding much more things also on the macro side. And if you find an asset manager which still has this drive and this also this energy to try out something new, to be a bit a trailblazer, it is fun for them. And those are exactly these asset managers our clients are looking for. Then don't need to be there yet, but they need to show this eagerness to go, let's say, also beyond these kind of action plan things. And quite frankly, most already do. And I can very good relate to Olivier's statement. Switzerland has lost it a little bit. So most asset managers we now look at are from the Benelux, and I saw that we have some friends from the Netherlands here. So you are pretty well advanced, Scandinavia as well. And we have a hard time finding the right asset manager in Switzerland. But I mean, we would welcome more, and our clients would be happy also to allocate capital to those who are just now beginning, but make it clear that they are serious about it.
That's a great call to action.
And maybe if I could just add something to Peter, and I think it's so true what he said, and we also need to take into account, if we are an asset financial advisor, an asset manager, is that till now, perhaps the integration of sustainability or ESG issues was seen as a competitive edge factor or a plus to have, and now legal compliance, everybody needs to do. So in case you want still to keep this edge on the competition, you need, as Peter mentioned, be willing to go the extra mile or continue being ahead of the pack. So I think this is an important message that I wanted to highlight.
Yeah,
and
great.
it's fun to do. It's not a burden. You should see it as a cool thing to develop. Where magic happens.
That's where the magic happens.
As it says in the background, yeah, that's really cool.
Yeah.
No, but also one comment from me quickly on this. I'm aware that we don't have much time anymore, but I think why hasn't this happened? So why haven't asset managers integrated these things? It's not because they're stupid or they're dinosaurs ready to being extinct. You know, it's just because you don't feel those risks yet. I think that's really crazy. You have certain cases, you have certain companies where you have bankruptcies, where you can show that the valuation of the firm has been impacted. But the problem we have is that the regulators are not regulating the real economy. There's still no carbon tax. There's still no clear roadmap for the transition of the different industries. So it doesn't translate yet in transition risks. So even those financial institutions who want to understand those risks have difficulties in their models to actually show that all these different aspects, which Peter mentioned before, like the strategic asset allocation, all these things are actually really impacted by those topics. And what I fear is that the longer we wait with the policy action in the real economy, the more brutal the transition risks will be. And that's why I think it's even more important for financial institutions and asset managers and advisors to now prepare for that and understand those risks and be ready to communicate and measure them. And And with these others, you also mentioned, Peter, it's not only about the environment. Take the human rights aspect, for example, where you also have a big impact discussion, whether it's positive or negative impact. But that's also why this adverse impact is so important, this additional perspective. It's not only about the risks, it's not only about sustainability risks, it's also about the adverse impacts I may create for investment decisions, because there, unfortunately, there's just no price tag on human rights violations normally. So there needs to be this combination of these approaches, and it's a challenging task, but it's really, really timely. But what we need, and that should be a call from the financial sector to the regulators, don't only regulate us, please also regulate the real economy, because that's where the change has to happen.
It's a great point. And it's now, I'm now see that it's 11, so or 11 in Central European time. So I think, yeah, we could continue this conversation for a really long time. I find it really interesting, weirdly, because actually regulation is not very interesting to me, but this is a very interesting topic. And I'm really glad about that we could get together and discuss it here. Thank you so much for attending. Those of you who are in the audience, we really appreciated having you. If you have any further questions, I'm sure any of the speakers here would be happy to follow up. So you're welcome to write me. It's Erin. Yeah, well, I think you would have received my email in your email, so you can write me and I can connect you. And we have another webinar coming up. It's on the inconsistencies of ESG ratings. That is from one of our researchers and then another researcher at MIT. So Michelle will be sharing the link in the chat if you want to register for that. That's in November. I don't have the 24th. And with that, yeah, thank you so much, Gabriel, Olivier, and Peter, for joining me on this call today. It was really fun having you. And thank you for the audience for attending.
Yeah, same here.
Thank you very much to you, Erin.
Thank you very much for having me.
Thanks. Have a great rest of your day, everybody.
Bye-bye.
Take care. All the best. Bye.
Bye.